All right, if you're doing business in Thailand, one of the first big questions you're going to hit is taxes. Today, we're cutting through the confusion to demystify the two most important indirect taxes you'll face: value added tax, that's VAT, and specific business tax, or SBT. Let's get right into it. So, picture this. You've just closed a deal, you've made a sale. Fantastic. But now, who's actually on the hook for the tax on that transaction? Is it you? Or is it your customer? The answer to this is going to unlock this whole system for you. And the answer is, it's your customer. Yep, this is the whole idea behind something called an indirect tax. Your business isn't paying the tax from its profits. Nope, you are simply collecting it from the customer and then passing it along to the government's revenue department. You're basically the middleman. So let's just make that official. An indirect tax is exactly what it sounds like. The real financial hit, the burden, gets shifted over to the final consumer. It's a tax on what people spend, not on what your company earns. Now that we've got that down, let's look at the main system you'll probably be dealing with. And that brings us to the big one: value added tax, or VAT. For most businesses here in Thailand, we're talking everything from manufacturing and services to your local shop. This is the default system you'll be operating under. So, what on earth does value added even mean? Well, think of it like this. Let's say you buy some raw materials for 100 baht, and you work your magic and turn them into a product you sell for 150 baht. You've added 50 baht of value. That is designed to tax that 50 baht slice you created. And here's how that works in practice. It's a really simple three-step dance. First, you collect the tax from your customers when they buy from you. That's called your output tax. Next, you get to deduct all the tax you already paid to your own suppliers. We call that your input tax. The difference between those two numbers is what you send over to the government. It's actually a pretty clever credit system. And what's the magic number you'll be working with? Right now, the standard VAT rate in Thailand that you'll be collecting and paying on almost everything is a flat 7%. Okay, this is where things can get a little bit tricky, but it's a super important distinction to get right. You'll hear the terms zero rated and exempt. Now, in both cases, your customer doesn't pay any VAT. So what's the big deal? Well, it all comes down to what happens to your input tax. Let's break it down. If you're an exporter, your goods are zero rated. That means you collect 0% VAT from your international customer. But, and this is the absolute key, you get to claim back every baht of input tax you paid to your suppliers as a cash refund. On the flip side, if your business is exempt, like a hospital or some types of agriculture, you also don't charge VAT, but you cannot get a refund on your input tax. It just becomes another cost of doing business. Now, just when you think you've got this all figured out, there's a bit of a plot twist. See, not every business fits neatly into that VAT system. So let's meet the big exception to the rule: the specific business tax, or SBT. And that really gets to the heart of it. I mean, how would you even begin to calculate the value added on a bank loan or on the sale of a condo? It's not like you're buying parts and putting them together. The normal VAT formula just doesn't work for these kinds of industries. And that, right there, is exactly why SBT exists. It's a totally different system that was created for businesses where that normal input minus output method of that is just not practical. It's a much more direct way to tax the overall income of these unique businesses. So, who's in this exclusive club? Well, we're mainly talking about the financial sector. So, commercial banking, finance companies, life insurance, even pawn shops. And a really big one, the business of selling real estate for profit. If you're in one of those fields, you're almost certainly playing in the SBT world, not the VAT world. All right, now that we've met our two main players, it's time for the showdown. Let's put VAT and SBT head to head so you can see the clear, practical differences between these two tax systems. So what's the real difference when the rubber meets the road? Let's put them side by side. Honestly, if you can get this next part, you've mastered the basics of Thailand's indirect tax system. This is where it all comes together. Look at the calculation. VAT is a net calculation, output tax minus input tax. But SBT is a simple gross calculation, your total revenue times the tax rate. The rates are different, 7% versus a common 3.3. But the most critical difference, the one you have to remember, is that with SBT, you cannot claim back any input tax. It's a one-way street. The money goes to the government, and that's it. Even the forms you file are different. Theory is great and all, but let's see how this actually works with some real-world numbers. We're going to run through 2 quick case studies that'll make this crystal clear. First up, let's take an exporter. This is your classic VAT scenario. Imagine a company buys 1 million baht worth of rice from local farmers, and their plan is to export all of it. On that big purchase, they had to pay 7% VAT to their suppliers, which works out to 70,000 baht. Okay? That's their input tax. Now, because they're exporting the rice, that sale is classified as zero rated, which means the output tax they collect from their customer overseas is, you guessed it, 0. So let's do the math. An output tax of 0 minus an input tax of 70,000 baht equals negative 70,000 baht. And what does that mean? It means the government literally sends them a check for 70,000 baht, a full tax refund. This is the system that helps keep Thai exports competitive on the global stage. Okay, case study number 2. This time, we've got a real estate developer who sells a condo unit for 5 million baht. Since this is the business of selling property for a profit, we know it falls right under SBT. The calculation here is way more straightforward. You just take the gross sale price, 5 million baht, and multiply it by the SBT rate of 3.3%. Boom, the tax they owe is 165,000 baht. It doesn't matter one bit what VAT they paid on cement or windows or anything else. That's all totally irrelevant in the SBT system. It's just a simple, direct tax on their total revenue. So let's wrap this up. We've looked at the main system, VAT, with its really powerful input tax credit system. And we've also looked at the specialized system, SBT, which is designed for a very specific list of industries. The most important thing is simply knowing which of these 2 paths your business has to walk down. And that really is the final crucial question you need to ask yourself. Are you in a business that adds value along a supply chain where you're constantly tracking input and output tax? Or are you in one of those specialized sectors like finance or real estate, where a simple tax on your gross income applies? Knowing the answer to that is the first and honestly the most important step to correctly navigating Thailand's tax maze. Thanks for tuning in.